These are the 5 mistakes that are keeping you poor in crypto. And these are the 5 mistakes that kept me poor in crypto for my first few years in the space. If I had known these when I started, I think I would have hit my goals significantly quicker. So hopefully today's video helps you reframe your thinking about the market and also introduce some strategies which can help you smash not just the next year, but pretty much your entire investing journey. So I've tried to really nail down the 5 things that I think are going to make the biggest difference in your portfolios because they've made the biggest difference in mine. If you're new here, my name is Deutscher. I'm a crypto analyst. I've been in the space for 6 years, and this channel is dedicated to giving you evergreen strategies, frameworks, and mental models to helping you succeed in the market. And then I also have my main channel, which goes through more up-to-date market-related stuff. So make sure you're subscribed here if you aren't already. And without further ado, let's get straight into the video. All right, so mistake number 1, this is being fully invested in the market. Now, at face value, this might not seem like a mistake. You might think, well, if I'm fully invested, that means I'm maximizing opportunity. And although it seems like that, it's actually not the case because you're giving up the opportunities and giving up the flexibility to get into new trades, new positions, and seize opportunities as they arise in the market if you are fully invested. I've personally found my investing, my risk management, and my ability to take on risk and deal with that risk is much, much better when I'm not all in the crypto market. Now, this doesn't mean being 100% in stables. It doesn't even need to be 50% in stables, but just keeping 10, 20, 30% of your crypto portfolio in stablecoins or fiat can help a lot in terms of seizing the next opportunity in the market. So ironically, by not being all in, you'll actually create more opportunities and you'll have the necessary firepower to actually buy in on dips and buy in when everyone else is scared. And honestly, especially like on liquidation wicks, for example, if you've got limit orders set, these are the best opportunities to make money in the market, but you can't set those orders or execute if you're fully invested all the time. And it also makes the game a little bit too emotional. I've had periods where I've just been all in and too emotional, like it's hard to sleep at night, it's hard to make objective decisions. All of that stress is taken away if you manage your risk a little bit better. On to mistake number 2, and this was one that I made for years. It's being complacent in the market and not tracking my portfolio performance. You know when the market's going down and you don't want to refresh your portfolio tracker because it's honestly depressing to look, and you know when the market's going up and you don't feel like you need to refresh your tracker because you know you're making a bunch of money, or if you do, it's just to check how much money you're making and not actually monitoring your positions. Well, yeah, I used to do that for years, and it's only really until the last couple of years where every single day I made it part of my habit. It's literally on my daily Notion checklist to do a full portfolio review. Now, this portfolio review is not just saying, okay, cool, looks good. I actually screenshot it. I have a dedicated ChatGPT chat, and I've put in my parameters. So here's my risk parameter. Here's my maximum position based on my risk tolerance. This is my ideal portfolio weighting, and I get it to analyze the current day status based on what my portfolio looks like right now. And if you want to go to the next step, you can actually build, and I did this, a custom Claude dashboard. The new model is absolutely amazing, which enables you to track your portfolio. Now, it doesn't have real-time data input, so you'll need to get it from CoinStats, or you can create Google Sheets with APIs, or you can even manually update. But once you feed it the data, it can populate a chart for you and make sure that you're on track with your goals and on track towards your risk tolerance. For example, if a low cap starts to go over a 5% weighting in your portfolio and your parameter is you don't want to hold more than 5% of your portfolio in a low cap, it'll be able to alert you of that so you can make a change. A lot of the time, it's not actually bad decisions which kill you. It's the decisions that you aren't making. It's the complacency to not cut a position despite the fact it dropped below your predetermined invalidation threshold that's killing you. And the only way to know that is to be aware of it and make it a habit to actually check and regularly review your portfolio. Even if the market's bad, there's this tendency when the market's going down to just ignore stuff and just bury it under the rug. But that's actually the worst thing you can do. You need to be aware. So that's why mistake number 2 is complacency and tracking your performance. Mistake number 3, you chase every hot narrative and trend instead of mastering one. It's so easy to get caught up in the market. When perps are performing really well, you want to be a perp trader. When DeFi is doing really well, you want to do DeFi farming. When airdrops are doing really well, you want to be an airdrop farmer. When gaming or AI is pumping, you want to be an AI expert. When a certain narrative is going off, now you're hopping to that. The problem with crypto is that there are always many opportunities So it can actually blind you long-term to the most impactful opportunities to consistently focus on. I was kind of lucky because when I came into crypto, I got really obsessed with DeFi summer in 2020. When Ethereum staking became a thing, when you could play around with Maker and Curve and there were liquidity pools for stablecoins, like I got my hands dirty in DeFi. And I'm very thankful for that because DeFi is a niche which teaches you a lot about crypto. It forces you to manage risk. It forces you to look at on-chain flows. It forces you to understand fundamentals. It also forces you to have at least some semblance of charting and price action. So I feel like getting my hands dirty, there was really no replacement for that in the market. You know, I could have studied theoretical trading for years, looking at price level, support, resistance, but there was nothing like getting my hands dirty, actually trading, farming, and doing all of this stuff. And DeFi enabled me to do that, to actually learn about the market. So by going all in on that, I was able to transfer those skills later on into other elements of crypto. But I don't think if I didn't go all in on DeFi, if I would have developed the necessary skills to be a fundamental narrative trader now, I almost definitely think I wouldn't have. So that's why if you're starting crypto today, or if you're a bit newer or less experienced in the space, I recommend just picking one thing and going all in. Now that thing could be low time frame trading. You know, if you want to learn to do perps trading, that's great. But, you know, commit to that and learn how to implement a technical based system. And obviously having some knowledge of the fundamentals is going to help a lot in terms of understanding what coins to trade and actually framing your risk reward on those trades. If you want to be an expert in AI, well, go deep into AI, how to research crypto with AI, what protocols are implementing AI. Go deep into one thing. Don't spread yourself too thin across the market. Either choose to be a short-term trader, a high time frame swing trader, a narrative trader, a long-term investor, a news trader, so scalp trading as well. This is where you quickly decipher news and work out whether there is an opportunity or an information or time asymmetry to capitalize on. But it's all about building an edge. And it's hard to build an edge when you don't focus on one thing, because there are people out there that are just focused on one thing. Like they're Solana trench experts. They know everything about on-chain Solana. They're always tracking it. Those skills are also translatable to Base or BSC or other chains, but they really know how to like look at whale wallets, look at on-chain flows. They know how to ride these low caps. They know what telegrams to be in. They know what to look for, because it's a very specific niche. If you're trying to hop between too many niches, you're going to fail. So I recommend picking one thing and focusing on it. There are some people that just do airdrop farming, but they've really learned how to focus on that thing. And that doesn't mean you can't invest, by the way. You can have a passive portfolio of Bitcoin and maybe a few altcoins, which you leave whilst you focus your energy on one thing. So here I'm not talking about where you're allocating money. I'm talking about a resource which is vastly more important, and that is your time and energy. Your energy, 90% of it needs to be focused on one thing, and then you can focus 10% of your energy on, long-term investing. I've got Bitcoin, I've got stocks, I've got some coins that I'm holding longer term, but I don't put any energy into them. They're just DCAing, I leave them, they do their thing, and then I focus on the things that matter each day with my waking energy. So I think that is an important thing to get a hold of. Okay, mistake number 4, you don't have a selling plan. And this is probably the highest leverage thing that you can do to just make your trades and investments so much better. Before you open any position, have a predetermined invalidation, either fundamental or technical, and have a predetermined level where you're looking to take profits. Now, the take profit level doesn't have to be a number. So if you buy Solana at 200, it doesn't have to be 250, 300. It could just be a percentage. Like, every time it goes up 50%, I take 20% off the table. And based on your outlook towards that coin and how risky that coin is, that'll dictate how aggressively you take profits. Like a risky on-chain meme that goes from 5 mil to 10 mil, well, on a 2x, you probably want to take 50%, so your initials off the table. Whereas if it's, Solana or a larger cap coin, you're probably looking at taking smaller increments on smaller incremental price increases. So if it goes from 200 up 10% to 220, you might take just like 10% of your overall stack, so you can, let the rest grow. But by having predetermined take profit levels and predetermined invalidation levels, and that's where having at least a basic understanding of technicals come in, even if you're a fundamental trader, that just makes things so much easier and also increases the risk reward on your trades. And the other thing is, even if you don't have a predetermined stop loss, it goes back to the other mistake I talked about earlier in the video, complacency. If you're not complacent and you're checking the charts, you can actually see when momentum starts to cool on a coin. So your invalidation could be, look, I'm just going to ride this coin as long as it looks strong, but the second it starts to look a bit weak, then I'm going to cut my exposure or cut a percentage of exposure on the coin. And that's where having an organized trading view watch list is very important. Have all your active positions and all your prospective, so positions you might enter, in 2 separate folders, and just scan them each day. Just have key high time frame levels marked out, and then you'll always know when to invalidate. But if you go into the market or if you go into a trade without a plan, you're basically setting yourself up to fail. And if you hold a portfolio right now where you don't have a plan, the good news is it's not too late to make one. Go through each coin in your portfolio and make a retroactive plan. It's not ideal, but it's better having something now than having absolutely no plan at all and not really knowing why you're holding an altcoin or where you'd sell or what your outlook is on that coin. Now, mistake number 5, this is a very niche one, but it's a really important mindset shift that I wanted to tell you guys about today. And this is denominating your portfolio in the wrong currency. I did this for years, and it's only really this year that my mindset's changed, but you need to stop denominating your portfolio in US dollars. Now, having an idea of where it is in US dollars is great, but at the end of the day, your goal as a crypto investor, at least in my opinion, is to outperform Bitcoin. Because if you could just long Bitcoin and get the same returns or better returns, then it's, from a risk-adjusted return perspective, more optimal to long Bitcoin than longing altcoins. Altcoins, you're taking substantially more risk. So you would only long an altcoin if the reward was so much better that it outweighs the amount of risk that you're taking on that trade. Thus, in order to nail the altcoin game, you should also be tracking your portfolio in Bitcoin and, to a lesser extent, Ethereum to make sure that you're actually outperforming. Because if you're underperforming versus Bitcoin, then you may as well just hold Bitcoin, actually get some decent sleep at night, and then be able to focus, as I mentioned before, your energy on more impactful high upside things like certain niches in crypto and building a business and other stuff like that, which can increase your income more substantially and actually move the needle more in terms of your portfolio. So you can't outperform altcoins, just hold Bitcoin. But how are you supposed to outperform in altcoins if you're not tracking your portfolio versus Bitcoin? You need to be aware first before you can actually profit. So I think a big mistake is just track your portfolio in US dollars. Track it in Bitcoin. It'll really change your perspective and it will just make you more aware of risk reward on trades. And I'll give you a bonus tip. When you're charting altcoins, don't just chart them versus USD, chart them versus their Bitcoin pairs. So if you want to buy into Solana, yes, validate the entry on the dollar chart because everyone else is looking at it, but also validate that entry on the Bitcoin chart. Does it look good on Bitcoin? Is it bouncing at a key level? Is it at an uptrend? Typically, I don't want to be buying alts that are in a strong downtrend against Bitcoin unless they're starting to reverse. I'd rather wait for that rotation to take place and then go heavier than trying to front run it too much. So not only track your overall portfolio in Bitcoin, but also track individual altcoin positions in Bitcoin. You'll be a much better trader for it. So those are the 5 mistakes and ways to rectify them in the space. These are things that I've learned over my past 6 years in crypto. Honestly, I could have done a 15, 20 mistake video because there are other mistakes like, not taking profits and, being too aggressive and failing position sizing. So it's hard for me to nail it down, but I just thought these 5 things covered the breadth of the market quite well. And, will give you actually a more manageable, actionable plan going into this next period. But you can take these pretty much forever because these rules don't really change and haven't changed in the last 6 years of me being in the space. But obviously in the current environment we're in, risk management is probably more important now than ever. So I'll see you in the next video. Make sure to subscribe to the channel if you did enjoy this video, and I will see you in the next one. Have a lovely rest of your day. Peace out.